Hi everyone, welcome to session 9.3. In this session, we're going to go through NPV and IR functions and auditing, and we're also going to take a look at some errors and how to fix them. And we're going to be looking at rate of return, calculating internal rate of return, auditing, and so on. So basically, we're going to continue on with the formulas and the example that we were using before, but we're going to get a little more in depth into some of the formulas, and we're also going to introduce a new thing called the watch window, and we're going to look at formula evaluation towards the end of the module. So a few new concepts, but generally most things that we're pretty familiar with, and we'll just carry on using our workbook. Okay, so we'll start off by, you can look at the calculations that are on page 568, and we'll start off right at the bottom. We'll go to the startup worksheet, and we're going to go to cell B31 right over here. We're going to enter $200,000. Okay, so we put in 200,000. There we go. And this is the amount that's going to come from our investors, like we talked about at the end of 9.2. So now let's go to the investment analysis worksheet. There we go. And this is what we're trying to interest people investing in the company. This is particularly an issue because if you remember where we last left off, we're actually not going to make money in the first year. And although we're going to make close to $500,000 in the fifth year, we want to make sure that we could afford to stay in business that long and have the initial capital to start up and get things going. Okay, so let's go to B6 and we'll type equals minus. You'll remember that the reason why we do this is because we want to flip the negative value. We'll go to the startup worksheet and we're going to click on cell B31 and hit enter. Okay, so we take that $200,000 positive cash flow that's coming into the company that we're getting, right? And we're going to put it in as a negative because that is the investment. Okay, so the formula displays it as negative 200,000. You want to use a negative value because you're examining the investment from the perspective of the investors who are making the initial payment of 200,000 to the company, which is a negative cash flow. All right, so let's go to B7 and we'll put in 45,000. So the annual payment to the investors will be 45,000. It's a positive cash flow because they're getting back the money being paid to them, right? From their point of view, a positive cash flow. In B8, we'll put in 5 as the number of payments over 5 years. And in B9, we'll put in equals rate. Okay, returns the rate of interest for a loan or investment. And we'll do B8, comma, B7, comma, and B6. Close bracket, and we'll get back our rate. So basically, if we borrow 200,000 from investors, we're paying them back 45,000 a year for 5 years. The rate that we're paying them back is 4.06%. Okay, so based on the calculations, the annual interest rate to the investors for this payment is 4.06%. Okay, so in other words, what this means is if we take this payment that we're making times 5, we would be paying back 225,000, and we're borrowing 200,000, or they're investing into the company. All right, so this is great, but there's a problem if you look at page 570, and that is that Ryan doesn't believe he could attract investors if all he could promise is a 4.06% of annual interest return. Another possibility is to pay back the investors in dividends from the company's profits. Because the company won't show profit in the first year, is actually going to lose money, there'll be less cash to pay dividends. So he said the following schedule. In year 1, you get 0. Year 2, you get 0. Year 3, 8,000. Year 4, 15,000. And year 5, 25,000. He wants to add these dividends to the repayment to the investor's original 200,000, and then we'll calculate all of that all together. Okay, so let's take a look at that. In cell B12, So we're in year 1 for payments. We're going to put in equals B7, and we'll hit F4 and put that in dollar signs. All right, so we have the 45,000. Then we're going to copy B12 out to F12, like that. Then in B13 to F13, we're going to put in 0 in B13, 0 in C13, 15,000, oops, that's not right, 8,000 in D13, 15,000 in E13, and 25,000 in cell F13. And this is the dividend that we talked about. So this is going to be in addition to the amount that we're getting paid back, to the investors are getting paid back. So then we select the range B14 to F14, like this, and we hit auto sum. Alrighty. So in year 1, we have 45,000 in payments. That's coming from here, our payment schedule. How much dividends are they getting in addition to that? They are only getting the 45,000, no dividends. Whereas in year 3, as the company's making money, they get 8,000 dividends, 15,000, 25,000, and their payments go 45, 45, 53, 60, 70. So they're getting paid more as the company makes money. Okay, so let's go in B18, enter the formula equals B6. That's the initial investment value. In cell B19 to B23, we're going to put in the following formulas to reference the annual payments to investors. We're going to put in equals B14 in cell B19. B14, there we go. So that's for year 1. C14 in B20. D14 in 21. E14 and F14. Okay, so basically we grab the totals over here and we transpose them over here. Okay, so now we're going to go B18 to B23. And we're going to click on Click Analysis. And whoop, there we go. We're going to click on Totals. And we're going to go to our running total over here. All right, now if you're using a Mac and you don't have that feature, you could figure it out manually as well, and I'll show you how to do that in a second. And basically what this is going to show you is the running total that the investors are getting back. So in year 1, the investors first put in the 200,000. In year 1, they get back 45. In the second year, they get back another 45, then 53, 60, and 70. In the first year, they're out 200,000. In the second year, by the year 1 payment, they're out 155,000. Year 2, 110. Year 3, 57. And then by year 5, the investors are getting an additional 73,000. So basically, you're saying to the investors, wait for the 4/5 years, and you're actually going to make a big profit at the end, in addition to the 200,000 that you put in. Okay, so if you look at the formulas, this is basically saying sum these guys, whereas the one before it is saying sum one less, sum one less. So you could do this manually if you don't have quick analysis. It just takes a little longer, right? But it's possible to do. Okay, so we're on page 571 at the top. Based on these calculations, the investors get back their investment in the 4th year. So basically, now they recovered all their money. And by year 4, and by year 5, they've made 73,000 in profit. Okay, so read through calculating net present value and the time value of money on page 571, as well as the NPV function. And we're going to pick up at the bottom of page 572. So basically the idea is that if the investors chose to put the money in a bank account, they would get back a small amount of profit, of return. But because this is a riskier venture and there's the possibility of making a lot more money, and we need the money, we need them more than they need us, the investors are going to want a higher rate of return. So after discussing the issue with financial analysts, Ryan settled on a 10% rate of return, meaning that the QR shopper would return the investors at least as much as if they put the $200,000 in a bank account with a 10% interest rate. So we're going to use the rate of return and NPV function to calculate the net present value of the proposed investment to the QR startup. So let's go to C25, that's over here, and we're going to put in 10.0%. And cell C26, we'll put in NPV, C25, and then we'll put in B19, B19 to B23. There we go. Okay, and then C27, we're going to type in equals B18 plus C26. There we go. 2364. Select C26, figure 9.25. So we have a 10% rate of return. We have the present value of future cash flow and the net present value of the investment. According to these results, the $200,000 investment is worth $2,364 more than the payout obtained by placing the same amount in a savings account that pays 10% annual interest. Of course, this assumes that QR Shopper is as profitable as Ryan claims. Okay, so the idea is that as compared to a 10% bank account, they're actually getting back an even better rate. Okay, so next we're going to talk about the internal rate of return. Read through on page 574 and 575, and we're going to start off at the bottom of 575. Okay, so we're going to click on cell C28, and we're going to enter IRR B18 to B23. Okay, so we get back 10.43, and this is the initial investment and returns the investors can expect. The internal rate of return is 10.43 in cell C28. There you go. Figure 9.27. Based on the IRR calculation, the internal rate of return, Ryan can tell potential company investors that they would get a 10.43% return on their investment. If this analysis is correct, that would seem like a worthwhile return compared to other competing investments. Because basically we're telling the investors, we want you to get back a bunch of money. Here we're offering you 10.43% return as opposed to the 10% bank account. Now when we just ran the numbers before, we couldn't compete with a 12% bank account, but we could do much better than a 5% bank account. Okay, so the next one that we'll do is on the bottom of page 578. Take a look at exploring XNPV and XIRR to take a look at cash flows with unevenly spaced payments. Let's take a look at income statement. Here we go. And we'll go to B33. All right. And we'll type in equals, and we'll go to investment analysis. Of course, they always send us somewhere else. And we're going to go to B13. So that would be right there. Investment analysis, B13. We'll hit enter. And we should get a 0. In cell B35, let's put in equals B31 minus B33. So we're taking our after-tax profit and we're deducting our dividends to shareholders. And let's hit enter. Okay, so we have a net loss of $39,459, because keep in mind that we're not paying dividends in the first year. Okay, so now it says B33 to B35, so we'll grab it like that, and we'll copy over the formulas. So this is the bottom line, if you will. Okay, so here we have the amount that we're paying dividends to shareholders, like you can see in figure 930 on page 579. And then finally, at the end, based on these calculations, the retained earnings of the company will grow to $231,364. So this is the amount that we get back after everything else, after tax and after our shareholders get paid dividends and get paid back. Accounting for depreciation, interest expenses, taxes, and own dividends. At the end of the 5th year, we have completely repaid our $400,000 loan and completely repaid the investors. Okay, so now we've talked about this issue before when we've connected different sheets together, and this is the same idea but in the same sheet. So take a look at auditing a workbook on page 579. Ryan connects all these different values, and you notice that we've gone back and forth between different worksheets to connect values. The problem with this is that sometimes it's hard to figure out where a value is coming from and how to correct it. Okay, so it says that unfortunately some of these worksheets contain errors. Ryan asks you to locate the source of these errors and fix them, knowing that the source of the error could be located almost anywhere within the workbook. You'll start by reviewing the balance sheet and we'll locate the errors. So let's go to balance sheet, which is the next one over here. And right away we can see there's this row, and this row all look like they have some problems, and down here as well. Okay, so we see a bunch of cells that contain the name error, and that is a problem. So let's go about fixing it. We'll go to the cash flow worksheet. Okay, so we know that when we click on it, we're getting this from the cash flow worksheet. So let's go to cash flow, and we also see that we have several blanks here. We don't know what's going on. The source of the error is unclear at first. Is the mistake on the balance sheet or the worksheet or somewhere else? So let's take a look at one of these, for example. This is coming from here, but we're getting a name error. To help trace an error back to its source, Excel auditing tools help you explore interconnectedness and formula values within a workbook. So when we're tracing an error, we basically have to go all the way back. So if this is an error, but it's connected to this, then we have to find out, is this as far back as it goes? And then we know if we fix it in one place, it goes forward and fixes all the other places it needs to, because we could have many, many different formulas, all relying on the same cells at different levels, right? So let's take a look at page 581 and figure out what's going on. So we'll go back to the balance sheet. We're going to click on cell F9. And we'll go to formulas. We'll click on the error checking button arrow and trace error. Okay, so we click over here and we'll go to where it says trace error. Okay, so this tells us here that the problem is on a different worksheet. This tells us this is the dependent cell where the arrow is pointing down here. So that means this is reliant on the preceding cell, which is the precedent cell, which is coming before it. Okay, so now let's figure out where that error is coming from. So we'll double click on the tracer arrow and we get this go to dialog box. Okay, so we could click on here, and we're going to press OK, and it's going to bring us to wherever the problem is coming from. All right, so we ended up in F23. On the Formulas tab, we'll go to Formula Auditing Group, so that's up here, and we'll click the error checking button, and we'll go to Trace Error. Dun dun dun! All right, so it turns out that this error is being caused by something over here. Okay, you have to look at the direction that the arrows are going in. The tracer arrow passes through several cells in row 23 before going to B23 and settling on B20. Cell B20 has a single precedent indicated by the blue arrow, that's over here. Because blue is used to identify precedent cells that are error-free, the source has to be coming from here. So you see, like, where we have no problem until here, suddenly something happens, and because of this, causes all of that. Okay, so review the formula in cell B20 in the formula bar. So let's click on B20, and we'll see what's in there. It says sum B15 to, oh, I see a problem already. Now, it's funny, because when this happens in class, people are like, there's no problem, it's perfect, you know, and then, of course, there's some kind of problem. But in this case, the reason why it's not working is because it says sum, S-U-M-M, instead of sum, like that. We'll hit enter, boom, everything gets fixed. And now you'll notice they're all back to blue, right, because everything's working. Blue means that it's going great. We'll go back here. The other sheet, which is bringing in the number, is also good, and it's blue, so we're all good to go. Okay, so we changed it from sum with 2 m's to 1 m, and then they're good to go. Now, we'll click on remove arrows right here. And, whoops, sorry about that. I meant to click that one. There we go. Now we'll go to balance sheet. We have no errors on the sheet. Let's take a look. We seem to be good now. And we clicked remove arrows, and we're good. Okay, so depending on what the error what the error is and how the sheets are connected together, we could do a trace to find out what sheet the formula is coming from and what data might be causing a problem, because we may have to go back several levels or go through several sheets, especially if we're using a global variable that we set at different places. So we have like a global interest rate, but we use that 10 times, and then the formulas refer to each other. The document gets to be very interconnected, and this is a good way to find it instead of having to hunt through hundreds or thousands of cells to find out what's going on. Okay, we can also use the evaluate formula box, which I use all the time, and it's really, really helpful to see the different steps of what's going on. Like basically, how is Excel figuring out what it's looking at? And this could help us see where it goes wrong or where we put something in wrong. So let's go to balance sheet, and we're going to click on F34. So we have F, and we'll go down to 34. There we go. On the Formulas tab, we're going to click on Evaluate Formula, right over here. And it's going to show us this box that you can see in 934 on page 583. So this is the formula that's in there. We can click to display the underlined cell reference, and we can click to display the value of the reference. So from this dialog box, you could evaluate each component of the formula. This is sort of like when we open up a formula in insert function and we see the different parts and what they are. Okay, so we're going to click on evaluate. And what happens is F22 is replaced by the current liabilities for the year 0. F25 now gets the underlying reference. So we're going to click step in. So basically it replaces the value of that cell with the current value that's being held in it. We'll click on step in. And we're going to look at that formula in cell 25, and it will say equals loan schedule E38, which is our next row, indicating that cell F25 gets its value from E38. This could help us trace it back there as well. Okay, so then we'll click on step in. And where does this come from? Right over here, loan schedule. We've already moved, it moves automatically to the next page and shows us where that's coming from. Now we can go back a level by clicking step out and go back one. And we could also press close. In cell F25, change the formula from loan schedule E38 to loan schedule F38. So let's just change that from E to F. There we go. The total liability changes to 392 949 down here, matching the total assets in F18. The balance sheet is now in balance again. Okay. Okay, so I'm sure you've seen many times, we've done it in class, when we want to look at different sheets and we have so many different things going on simultaneously, often we'll go to where it says View and hit New Window. We've also talked about using Split and a number of other options to see a lot of data at one time. But it's also possible to, and that takes up a lot of screen space. So unless you have a lot of monitors, in this case, you need like 6 monitors to see all the different worksheets simultaneously. So we don't actually need all the real estate, all the space on the screen taken up by all the numbers. We only are interested in some of them. So I'll show you a way to do that using the watch window. So we're going to go to the income statement worksheet. Now we're on page 585 in the yellow box. On the Formulas tab, under Formula Auditing, we're going to go to Watch Window, the thing with the glasses over here. Okay, so we hit that, and we get this watch window. We're going to press Add Watch, and basically all this does is it keeps an eye on a particular cell and just keeps it updated. So we click F35, which is already clicked over there, and then we click Add. Okay, so now in our watch window, it's constantly watching the value of the cell and the formula that's running it. And we could just keep this off on the side like this. As we go through our different sheets, we'll always have this up here so we can monitor these numbers to make sure what they are. Okay, so now we'll click Add Watch. Whoops, I popped it in there. There we go. Press Add Watch. And now we'll go to F23. And we'll press Add. Okay, so now we can see the impact on these 3 values when the tax rate changes from 32% to 18%. Oh, I missed one. So we have F35, got that one. And we have F36. Nope, I'll add that one. So I press Add Watch. F36. Oh no, that's on balance sheet. There we go. That makes more sense. F36. Hit Enter. Press Add. There we go. Sorry, I had to fix them. I did it wrong the first time. So basically now I have my income, balance, and cash flow, and the right cells with the right values. Okay, so that should match. That should sort of match what I have here. Okay, so now we'll go to the top of the income statement worksheet and press F5. So go back to income statement, go to the top, and press F5. Sorry, we'll go to cell F5, which is over, oops, what did I almost say? Here we go, F5. We're going to change the tax rate from 32 to 38. Now keep an eye in the watch box. I hit Enter, and in the watch window, all of these values will change as well. Okay, and we can see that in figure 937 on page 585. So instead of having to flip back and forth through the sheets, we're always able to keep an eye on those particular cells and what's going on. We can also take this window, like I did before, and we could embed it inside the sheet itself. We could just pop it up here. So as we're working, we could see these update. Okay, and then to put the tax rate back to where it's supposed to be, we click here, 32%, and we're good to go. And that's it, Module 9. Congratulations, you made it all the way to the end. I know this has been a really big module, and we've covered a lot of new stuff. Next module, Module 10, we're going to be looking at a what-if analysis, looking at different scenarios with numbers and seeing what we, which one is better decision making. And then we're going to start our projects, which are going to be really fun and interesting, and learn a bunch of new things, like, for example, formatting text and some more advanced functions. I hope you guys got a lot of this, you enjoyed it, and give it some practice. I know it's a ton of material to take in, but if you do the examples like we just worked through now, that should really help you pick up the basics. Have a fantastic day.